You must have heard about traders who trade with a $1,000 account and turn it to $10,000
Easy.
or $100,000 in a space of time. But what is the hope of a broke trader who is starting from scratch and don't have enough capital in his account? You see, many of you think that you need a lot of capital in your account, like $200, $300 or $1,000 to be able to make money with trading. But the truth is that, even when you are trading with a $1,000 account, you can still lose everything in a day. And that's because you lack the three things that will help you to grow trading accounts. With these three things, you can be able to raise small trading accounts. I mean small trading accounts with even as little as $4. All my students are following these three things, and they have been able to raise a lot of accounts using them. But knowing them is not just the end of the story. You will have to go deep inside each of them to really understand why you need them for your trading and how they really work in the market. But before we get into all of that, do well to like this video and subscribe to our channel. If you are encountering us for the first time, now my tribe soldiers, let's get down into this business. These three things that you're about to learn in this video is not just important, but if you fail to learn them, you will pay the ultimate price for it. These are the exact things that me and hundreds of students that I have taught are using to minimize our risk and make mouth-watering profits from the market daily. I will outline these three things for you right now. It might be simple at first, but towards the end of this video, you would thank me with a cold beer and a pack of chocolates. If you take these three things out of the life of any profitable trader in the world, he will be left with nothing within a week of trading. These three things involve 1. A working broker, 2. The asset strategy, and 3. The main overall account risk management plan. Now let's start with the broker. You might be wondering what I mean when I say a working broker. The truth is that there are many brokers in the market that are out there only to make profit from traders. They have nothing creative enough to help traders make money. All they care about is how to make their commissions the easy way, and also the illegal ways. Their overall game is built on manipulations, unexplained takeouts, even when your stop loss has not hit, high minimum deposit requirements, and very sneaky terms and conditions. The market is already full of challenges. While stress yourself out with some unnecessary challenges, which you can always avoid. Although there is no perfect broker in the market, but there are brokers that are way more better than other brokers in the market. That's why for the past 7 years, I have been trading with a single broker. And the name of this broker is called Deriv. Deriv broker not only gives you the opportunity to trade comfortably in the market, with a very low minimum deposits, they also offer you freely their native trading assets, which we call the synthetic indices. Deriv synthetic indices are the lowest risk assets in the whole of the financial market, and they are only offered by Deriv broker, meaning that you can't find it on any other broker in the market, except on Deriv. These are the assets that I have been trading for more than 7 years, and they have helped me to make thousands of dollars in the market, starting as a beginner with a very low capital, and helping me to scale up my capital exponentially. We will be moving into how these assets work shortly, cause these are our assets that we are going to use to make thousands of dollars in the market, using our small account. Now, in order to register with the broker that provides these assets, click the link in the description box below. Now, let's move into the trading strategy that we are going to use for our small accounts. And after that, I will be teaching you on how to manage your overall account risk management before a trade and after a trade. Now, let's move to the trading strategy. The trading strategy that we are going to use is a simple support and resistance strategy. This strategy works for a trending market. The first thing you need in this strategy is to see a trending market. For example, here we are in an uptrend, and as the market was moving up, you will see the market breaking structures after a short retracement as it is moving up, and in between all these retracement and break of structure is a particular price movement which we call the flip zone in support and resistance. This is when there is a dominant side of the market, In this case, it is the buyers acting as the major zones, and even if the opposition, which is the sellers, try to move in a strong way, the buyers will still take up the market to the main direction. So in an uptrend, the market will always take out the resistance zones, and when it does that, those flipped resistance zones becomes our target spots. So right here, you can see that the buyers were moving up, and then you'll see the sellers trying to bring down the market, and then the buyers reclaimed their position and moved past the resistance zone, breaking the structure and making it clear that they are in control of the trend. And when you see that, it gives you a rare opportunity in the market to make money, because when the market returned to this zone again, it is coming to pick up leftover orders and move the market strongly in the uptrend direction. It is the same thing for a downtrend, but in reverse. When the market is moving in a downtrend, the sellers are in control, and they will keep breaking the structures of the buyers. When you see the market make a move like this, where the price is going down, and then you see the buyers try to take the market up, but then the sellers brought the market down, dominating the market once again. This means that the sellers are still in control. And after this breakout, we have a flip zone. When the market returns back to this flip zone, there would be a strong price movement from that point to the downwards position, with which we are going to be making profit with. Now, before I release more information on this strategy and the examples of this strategy at work on the chart, I'll give you a list of assets that you can use to grow your small accounts while trading Deriv synthetic indices. This assets has the lowest risk in all of Deriv synthetic indices at the time of making this video. These assets include Jump 100, which has a lowest lot size of 0.1, Volatility 75 1x, which has a lot size of 0.05, Volatility 50, which has a lowest lot size of 4.0, and then Jump 75, which has a lowest lot size of 0.01. These assets are currently the lowest risk trading assets amongst all the Deriv synthetic indices. Changes can be made in the future, so anytime you are about to trade, make sure that you have already researched your lot size before trading it, to avoid unnecessary losses. Now let's get back to our trading strategy. When you are trading the market with the strategy, even when the market has already flipped to the flip zone, there is something that you must always wait for, and that is a pin bar entry candlestick to appear before you take a trade, which time the market returns to the flip zone, and you see a pin bar into the trade and make money from the market. Now, let's see some examples of this strategy at work on the chart. Now on this chart, you can see that the market is moving in an uptrend, and because it is moving in an uptrend, we are waiting to see the strong moves of the buyers and the short-term move of the sellers. So right here, you can see that the buyers were moving, and all of a sudden, you see the sellers trying to bring the market down, but they were overpowered by the strength of the buyers, which broke this zone here and made it our flip zone. And because of that, we can look out to see if we are going to get the next step of the strategy, which is the pin bar entry candle. And each time we are waiting for a pin bar candle to form, you must understand that we are actually looking for a bullish pin bar candle, because we are in an uptrend. If you see a bearish pin bar, you cannot trade it. The only thing that we can trade is a bullish pin bar, and right here, as you can see, our pin bar appeared, and it was a bullish pin bar candle, giving us a signal to enter a trade. When you see this signal, all you have to do is enter your trade and place your stop loss below the pin bar candle, and you'll take profit target at the next high. And as you can see on this chart, our trade was a very successful one. The take profit target was hit successfully. Now, before I move into the overall account risk management plan, let's see another setup of our strategy at work on the chart. Right here you can see that the market was going down in a downtrend, and as price was going down, you can see structures getting broken. Right here you can see that the buyers try to move the market up, but as you know, the downtrend is highly dominated by the sellers, so the sellers brought the market down, and at the same time breaking the support zone of the buyers, giving us a bearish flip zone. When we see this flip zone, we then wait for the market to return to the flip zone. And at the same time, we expect to see a bearish pin bar candle as price gets to the flip zone. And as you can see in this example, the market formed a bearish pin bar as it touched the flip zone. If you are fortunate to see a very good setup like this one, all you have to do is take your trade immediately you see the bearish pin bar appear, placing your stop loss at the top of the pin bar, and your take profit target at the next low. And as you can see here, this was a successful trade. The take profit target was hit successfully, though it is great when you see a good trade like this one. But what would determine if you will make a lot of profit from the market or not depends on your overall account risk management plan. It is your risk management plan that will determine if you are going to a long way with the current money in your account. This risk management will complement your trading strategy. Now, let me show you how you can manage your account in a way that you are making more profits on your trades and risking less, growing your account consistently to the top. In order to protect your account with the overall account management plan, there are few things you have to do. The first step is to make sure that your risk aligns with the overall account. So for example, if you are trading with a $100 as your overall account balance, you cannot enter a trade with a risk of $20 because you want to trade many opportunities in the market. So if you trade with a $20 risk on every trade, you will only have 5 opportunities to trade in the market. But if you trade with a $10 risk per trade, you will have 10 opportunities to make money in the market. And if you go down to trading $5 per trade, you will have 20 opportunities to trade in the market. The more the opportunities, the better your risk management, especially if you are a beginner, but at the same time, you want to make reasonable profit on your trades. So, risking $10 for each trade on an overall account of $100 creates a good balance between getting a reasonable number of opportunities and making reasonable profits on your trade. Risking $5 will be great, but I like to keep it at $10. Now, the second thing is your profit target on a trade. Now that you know about the risk, another very important part is the profit. Each time you want to trade, make sure that you are making 3 times your risk or more on every trade. Some traders make this mistake of trying to do a 1:1 trade. For example, risking $10 and making a $10 profit. But this is not a good way to grow fast in your trading account. The best way is to target 3 times your risk on every trade. It is always better to make $30 profit or more on a $10 risk than to make $10 profit on a $10 risk. This will make you stay longer and helps your overall progress in the long run. Doing this will help your account to grow faster. The last thing you must do to keep your account flowing in the right direction is to reduce the number of trades that you take in a day. This is the big Goliath that is standing in the way of many traders. Many traders love to trade, but they don't love to make profits. The number of trades that a trader takes in a day does not determine the amount of profits that he or she will make. And from a decade of trading experience, I know that traders who take less risk in a day make more profits than traders who trade many setups in a day. In order to become a more profitable trader and make progress, I will advise you stop at 3 trades per day. When you hit to losing trades, you should stop trading for that day and wait till the next day to refresh your brain, because at that point you are going to make more mistakes. But if you take your time out on the chart and you try to understand what went wrong in the losing trade, you'll be more likely to make profits in the next one. So in summary, you'll be taking 3 trades in a day, and if the first 2 trades were losses, you leave the chart and wait for the next day while analyzing your losses, and then, before you take a trade, you must make sure that you will be able to make at least 3 times the size of your risk on that trade, using the adequate risk amount for your trade according to the overall balance. Now you have received everything you need to become a consistent profitable trader. Now, go into the charts and multiply in profits. In order to start trading synthetic indices, register a new account with the broker. using the link in the description box below, and I will see you in the next one.